All right, so on the Money Show, we make sure that we don't just talk about investing in mutual funds, but also help you meet the brains behind these funds. And this week's Meet Your Fund Manager segment, we will be discussing Kotak Flexicap, and we have on board Harsha Upadhyaya, CIO Equity, Kotak AMC, to discuss about the fund and about the markets also. Hi, Harsha, and welcome to the Money Show. And we will talk about the Flexicap Fund today, and the message that's going around is elephant can dance. So AUM has crossed 38,000 crore and indeed a huge elephant. But then how do you decode the dance out here?
The fund is quite large in terms of the AUM, but clearly I think we have stuck to our discipline. The investment discipline that we have followed through cycles has really been fruitful in terms of investor returns, I would say. What we do in our fund is to look for opportunities which have compounding characteristics. So we look for businesses which are scalable, which have competitive advantage in their segment of operations. And also we look for managements which have great track record in terms of giving growth to shareholders as well as aligning with minority shareholders. And while we do all of this, we also focus on cash flow generation and capital allocation policies of the company. And finally, the valuation filter comes in. And if we believe that the valuations are fair, then we like to put those stocks in the portfolio. And generally, we buy and hold stocks for a long period of time. And that's the discipline that we have followed over the cycles over the last 11 years.
All right, Harsha. Now, before I go on with the questions, which are with the fund-specific questions, let's understand the basic sense of market. Our market rallies that we are seeing right now, is it sustainable? Do you think the party is over? And how are the valuations?
In fact, today we have made a new high on Nifty, and on mid cap we made a high quite some time back. So clearly, market has been an uptrend. Having said that, I think the fundamentals will take a little more time in terms of improving further. We do expect commodity prices to cool off from here, and that should help overall margins for most of the manufacturing companies in the country. But that's already kind of baked in terms of expectations. So to that extent, I would say part of the rally that we have seen already seems to have been discounted in terms of what is likely to come in terms of earnings growth over the next few quarters. However, the valuations still are not very expensive. So to that extent, I think the long-term investors can still continue to make staggered and disciplined investments and can continue to hope for decent returns from equities, even from these levels.
What about mid-cap and small-cap valuation? You think, are they overpriced, and is there more steam left, according to you, for more, maybe a month's time?
Clearly, in terms of valuations, they have been trading at a valuation which are higher than that of large caps. And also the earnings expectations for these two baskets have been higher than that for Nifty, which is around 14 to 16% over the next 2 years. So to that extent, I think delivery of earnings going forward for mid caps and small caps would be really crucial for them to sustain these valuation levels or to move higher from these valuation levels. So our base assumption is probably the volatility would be higher in terms of mid and small categories from here on, as most of the positive have already been discounted. And now it depends on how earnings trajectory comes through for this basket in terms of sustaining these levels.
Let's talk about your fund, Kotak Flexicap Fund, and help us understand how is the market cap exposure divided between large, mid and small cap?
Over the years, we have stuck to our discipline of maintaining a large cap tilt in this fund. It's not because of the size that it is managing today, but even when the fund was small, we managed to look at this allocation pattern so that the investor who comes into the fund is taking known risk in terms of what's the allocation and how it's going to move forward, irrespective of the cycles. So clearly, over the years, we have maintained about 65 to 75% allocation into large cap, and the rest goes into mid caps and small caps. The current allocation would be about 71% large cap and the rest in mid and small caps. We do not have too much cash in the portfolio as of now.
All right, which also means that you are fully invested, but then it also seems to be that you are a completely large cap biased fund. What are the sectors that you're holding in large cap category, and are these sectors the ones that you are banking on in upcoming quarters as well?
We have been looking at sectors which have been resilient in terms of growth as well as in terms of earnings going forward. We should have a kind of a steady earnings coming through. So from that respect, we believe that banking and financial sector as well as autos would be two sectors where the demand conditions are quite resilient, and also earnings expectations are quite strong as compared to the market. So these are two overweight positions in the portfolio. Along with that, we also have overweight on cement and industrials, which are closely linked to the economic activity in the country. And we clearly see that improving over the next couple of years. And also there are other levers in terms of margin improvement triggers that would come by as commodity inflation moderates going forward.
Let's talk about the banking sector now. We've seen that post results, there's not been much uptick in the pricing of these stocks. We've not seen stock specific action post the results also. How do you analyze the situation? Do you think that because of the result, the run-up is already peaked out in these particular stock, and which is why we did not see any movement, and now everything is actually depending on the new year's first financial quarter results, which will be obviously on your radar as well?
Some of the short-term movements are very difficult to predict, but clearly the overall banking and financial sector has been one of the outperformers over the last several quarters. And we do believe that as earnings growth trajectory for the basket is much higher than that for the market on an average, we should continue to see outperformance. Having said that, I think the kind of re-rating that we have seen in some of the names over the last year and a half also limits the kind of outperformance that you would see from this basket. It will be more from a bottom-up perspective that you'll have to choose right banks and right financial services stocks to make money from here on. I think the uniform up move that we saw in the sector maybe is coming towards its end.
And what are your sectors in mid-cap and small-cap category?
Some of the sectors that I mentioned, which are domestic-oriented sectors, banking and financial services, auto, cement, industrials, these are some of the sectors which also have representation from a mid-cap perspective in our funds. Along with that, there are several other bottom-up mid-cap ideas which may not be forming a big sector or a big exposure overall, but we do have several other smaller mid-cap and small-cap names which are looking good from a valuation perspective as well as from a compounding characteristics from here on. So those are the names that we hold in our portfolio.
Let's talk about few factors that might just ruin our market sentiment right now. Monsoon, that's a major concern. Do you think that's going to be a dampener?
Clearly, it's been a concern as of now. We have seen quite a bit of delay. Usually, we should have seen onset of monsoon by this point of time. Having said that, I think we still are at the early stages of the season. So to that extent, there is still hope that things will turn around as you go forward. And another point is while everybody believes that rainfall is critical for rural economy, over the years, the dependence on agriculture has reduced, and it's only about 40% of the rural economy which is dependent on agriculture. Rest of the rural economy is also dependent on various other areas, including infrastructure and sectors similar to that. So, in a sense that if in the worst case monsoon gets impacted, we may not see the kind of impact that we have seen in the last decade or maybe 20 years earlier, where our rural economy was more dependent on agriculture at that point of time as compared to several other sectors. The second point is, if you go by the kind of past data, you will notice that whenever monsoon has been lower than 6% as compared to the normal rainfall, that is when there has been a bigger impact in terms of overall economic growth of the country. Until unless it is not so a big disappointment, I think we should be able to manage that. And also, we know for a fact that last couple of years have been good in terms of monsoon. So the water levels overall have been better this time around, and we may not see that kind of a big negative impact. Overall, I think it's too early to take a call on monsoon, but definitely it's going to be crucial over the next few weeks to see how it pans out and what's the kind of impact that you would see on the economy, especially the rural side.
Harsha, last question to you now. Does having more than Flexicap fund make sense for an investor, given the fact that most of these funds are large cap buys? So even if one wants to have a Flexicap or more than one Flexicap, should they really look at the market cap or diversification before adding a Flexicap or more than one Flexicap?
Clearly, this is one of the segments where any regular investor should have an investment into. This gives you a kind of an exposure to the market, which is also in line with whatever you see in terms of the broad indices. For example, it gives a reasonable exposure to all the three market capitalization segments. And also, a lot of people believe that most of the outperformance comes only from taking an exposure to mid caps and small caps. That may not be entirely true. For example, what we practice in our fund is also to take a concentrated sector bets. So it's the investment approach is two-pronged. One, we take a top-down approach and try to select sectors which are likely to outperform the overall economy at any point of time. And once we select those sectors, we try to look for bottom-up opportunities within those selected sectors. So having a sectoral deviation itself is likely to give you outperformance if sectors are properly selected and the stocks therein. So on top of that, taking a mid cap or a small cap exposure is additional risk. So to that extent, we are very, very conscious of how much risk we want to take in this particular fund. So it will be a combination of our sectoral deviation as well as our mid and small cap allocation. So it's not going to be only a mid cap or a small cap allocation, which is going to drive likely outperformance in the fund. It will be a combination of both.
All right, that will be all. Thank you so much, Harsha, for being on the show, helping our viewers with all the aspects of Kotak Flexicap Fund and also the strategies they might want to adopt as per the market movement. Thank you so much. All right, we move on and time for a quick break, and then post that, let's talk about Indian markets which are inching towards life highs and the recent data and the profit that you're seeing on your portfolio. All of this and more after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Indian equity markets are inching towards life highs, and recent data from rate hike pause from the RBI and the US Fed to SIPs hitting all-time highs. Market seems poised for an extended bull run. So, in the current market scenario, how should retail investors plan their investments? What are the strategies that can help them get the most of their investments? Let's answer all of these questions. I have Shweta Rajani, Head Mutual Fund, Anand Rathi Limited, Ashish Kapur, CEO, Invest Shoppe India. Ashish, Shweta, good evening and welcome to the show. So Ashish, coming to you first, how do you read these all data coming from international data and Indian data, and even this particular week, that's very crucial. How do you read this data, and how would you like to decode this for an investor who has lined up their goals depending on the kind of market trajectory that we are seeing right now? If the goals are lined up properly, do they need to change their portfolio?
Yeah, hi. Thank you so much for having me over. Well, I think, frankly speaking, most of this, data which we are seeing or which we will see are, kind of, I would put it like that, put it a little bluntly, but I would say they are kind of noises which actually should not affect the investors. They are more for traders. So firstly, we need to define, are we investors or are we traders? I mean, of course, if we are traders, then we have to look at all these noises and react on them. If we are investor, then I believe you have some kind of, asset allocation in place, and you have to follow that. And within the asset allocation, whatever you have put in equities is either managed through a PMS or a mutual fund, or if it's being done directly, then the stocks are the ones in which you have done your research, or you have used somebody's help to do research. These things will not move by the market being near all-time high, or the fact that there is a lot of data which is going to come from global markets. These data points keep happening. Markets keep going up and down. You really have to go on your journey and see that you are, going as per your needs, your profile, and the shares or any other investment which you are choosing is well researched and matches with your goal and your profile. So as long as you've done that, I think this should not matter at all. In fact, this is part of the course. I think markets will go high. If you ask me, yes, time to certainly look at your portfolio, equity portfolio, and see if you can balance it a bit. If there is some things which have gone to your target, some stocks have hit your target, certainly book profits and move out. But don't base your decisions just on the fact that the market is near all-time high. Markets can go much higher. Markets do not follow any kind of rule like that. And near all-time high means it's an expensive market. So if there are some stocks which have reached your target, certainly book. Have a relook like you always do at the portfolio. Look at new ideas. If there's something which in your portfolio which is not giving you that kind of confidence, certainly book that and move into something which is looking better. All that relook and rewire and study of your portfolio,
That is a
examining of
very
your portfolio
important
should
point.
go on.
Exactly, that's a
But
very
nothing
important.
much in particular.
Yeah, that's a very important point that you're stressing on, and I think Shweta might want to elaborate is maybe rebalancing and reallocation in your portfolio, because if you are an investor who's following a diversified strategy across asset classes, this is a time where you might want to just adjust your portfolio. Doesn't matter if you have any goals aligned with it. I mean, that's obviously should be the prime reason why you have a diversified portfolio. But then if you are seeing profit in equity, time to just divert it somewhere. Shweta?
Yeah, Monica. So you're absolutely right that it all starts from you setting your goal, and to get to that return goal as well as the risk goal. Yeah. So when you talk about goal, it's not just your return. You may be wanting to target a 12, 13, 14% return, but at what risk level? That will help you take the next critical step, which is getting the right asset mix. So you may so choose to have a 70% equity and a 30% debt in your portfolio, irrespective of where the market level is. If you are at that 70% equity today, then continue with that allocation. You need not reduce it just because market is showing that it's nearing its all-time high level. No, that should not be the case. However, let's say you're 70% equity, you can have a plus minus 5% range. But if that 70 has gone to an 80% equity, then that's time for you to rebalance your portfolio and get it back to 70. But if you're still at 60% or 65% of equity on your portfolio today, then don't be worried about where the market level is. In fact, this is a level where you need to build in and get to your desired 70% allocation. So build in that. I'll just say one thing, that looking at the way the market is going today, you can have some shift within your portfolio, or some corrective measures that you may need to do so that you're aligning it to the changing market dynamics. For example, your large cap and your mid caps are trading at fair value. It's not expensive. I'll say it's not cheap. It's trading at a fair value. But your small caps, on the other hand, are trading at a discount to your fair value. So, within your allocation that you have, the 70% equity portion of the portfolio that you're maintaining, you may probably want to shift a little more towards small cap. So what we've been suggesting is have a 50% large, 20% mid, and a 30% small in your portfolio, because market is throwing up where there's a slight more attractiveness, whether it's your current valuations, whether it is what you're expecting in terms of earnings for the next 1 year, or a mean reversion to play out in small caps. So look at those indications that are coming in from the market and see how you want to, realign your portfolio and rebalance it only if you're above a certain range on your desired asset mix.
Interesting. Ashish, I also want to understand. So obviously now on radar we'll be having the New Year's first quarter results. Okay, those earning numbers. These are all near-term and short-term triggers that I'm talking about and discussing about. We'll further go into a long-term strategy or maybe a goal-aligned strategy with Shweta. But the kind of sense that you are getting right now for the first quarter earning results, which will actually decide the trajectory of the markets for next few months or maybe this calendar year end. How do you see it rolling out and how high? Because you just mentioned in your earlier answer, market can go higher than this as well. So how high do you think the market is going to fly now?
See, the best answer to that is again that, markets can surprise us. If you're asking me for my guess of what is going to happen in the first quarter results, I think all the indications are pointing out that we are going to have a very good earnings season because the economy seems to be really coming back in a very strong way. You can notice that with the automobile sales, which are going up and hitting record highs. You can see that by the way a lot of consumer companies are gearing up for the festive season. So certainly the economy is doing well. There can be some concerns regarding the monsoon, but too early to say anything definite on that. And I think even if that happens, there is some delay of monsoon or less monsoon this year, then mostly it will be rural sector which might get affected. But I think the urban sector is doing pretty well. These are all guesstimates. Now, what really happens in the broader picture, which is again what I'm pointing out, that if you're an investor, you're looking at obviously a longer horizon than maybe a couple of months, and the longer picture is still very, very positive for India because I think there is no other place no other country which is so large and growing at such a good steady rate. And with so many other positives kicking in the very high young population, growing awareness, growing aspiration levels, increasing infrastructure. Infrastructure is really improving. The road quality, the ports, the airports are really improving here. So I think the longer term trajectory is certainly going to go up. So if an investor, all you need to do is stay invested in the right kind of stocks or the right kind of PMS, mutual fund, whatever way you choose. There is no looking back. I mean, the couple of months here and there can go either way and should not deter you or change your course of action. I think whatever money you can spare or you have decided to keep it for equity should stay that way and should not move in or out just because monsoon might be a little weak. Maybe there's some valuation concerns for the very near term, or for whatever other international data point might scare you, or whatever be the other reason. I think broadly the markets are longer term trajectory is certainly up. I can tell you. It's very short term. Almost everybody can go wrong. Like I told you, my guess is everything is looking very hunky dory, but it could go wrong and can have some jerks, some volatility going forward. But that should not, make investors change their course or make decisions in a haste or just based on some short term data or some concern over something which is short term in nature.
So Ashish, time to go heavy on mid cap, small cap. Would you recommend that?
I think again, depending on your overall allocation, I would think that yes, if you are comfortable with the risk associated with the mid and small caps, it would be a time to go a little heavier on those stock specific ideas, which can be more mid cap, more small cap, or I would say more of the new technology, more on new ideas. You can take a bit of risk, but only if you're comfortable with that kind of risk taking. Large caps are more comfortable, more easy to track, and are less volatile, and are also less risky because chance of anything going majorly wrong in a large company is less. So only if you're an investor comfortable with tracking mid cap and small cap ideas and are used to of or are aware of the risks associated with them, should you go for that. But if you are that kind of investor, then yes, this is a time to maybe increase your allocation to the smaller companies, to the companies which are perhaps a bit riskier but have more long-term upside potential. Yes, you can do that. There's certainly a good time for doing that, because when the first phase of this market, what we have seen is broadly the movement coming in the larger stocks. So some of the mid and small cap ideas are still looking very attractive and haven't moved much. So that is where you can focus if you have the temperament and the research capability.
Shweta, so what kind of funds do you think one should be diversifying into? What kind of categories do you think one can actually bank on or maybe add on in their portfolio if it's missing?
Sure. You have today 10 categories which are defined by SEBI. But if I further break it up, then some of these categories, if you see their 5-year trend, the potential for alpha generation or return generation seems to be lower than others. So one category I would say that you can avoid in your portfolio or have a very low allocation is the large cap fund category itself. Have a 50% large cap exposure to your portfolio, but build that through categories like large and mid, flexi, focus. Those are certain categories that you should have in your portfolio. Definitely have a multi and a small cap because, like I mentioned, the small cap space at this point of time is looking attractive from a valuation standpoint as well as the earnings growth expectation. So these are two categories you must have. A contra category, to have something different or unique style bringing into your portfolio, and a dividend yield. So constructed in such a fashion where you have a well balance between large, mid, small. You'll also have a blend of value and growth styles in your portfolio. So, that would be my strategy. Just repeating, have a flexi, focus, large and mid, multi, small, contra, and dividend yield as categories for your mutual fund basket.
And apart from that, if at all you want a customized portfolio, maybe you would want to send us your question on the Money Show. With that, Shweta and Ashish, thank you so much for being on the show and helping our viewers with their portfolio strategies. And we'll take a quick break, but then post that, let's get your financial portfolio checked by Hemant Ustagi. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are a plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Hemant Ustagi, Wise Invest Private Limited. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Hemant, good evening and welcome to the show. And we are trying to connect to our first viewer who was there and the line just got disconnected, Ankur Goel. You have his question with you. He's 39 years old and he's lined up his goals. Okay, I have Ankur on the line with me. Ankur, hi. Good evening. How are you doing?
Hello. Hello, Kavita ji.
Hi. Where are you from?
Yeah, I am from Gurgaon.
Gurgaon. Okay. I can see you've done your planning really well. You've lined up your goals. You've given it an amount, the duration that's needed to suggest your investment strategy. And okay, I think he's again gone from the line. Okay. So child education goal, Hemant, by 2030 he needs 50 lakh. Child marriage 2037 he needs 75 lakhs, and retirement corpus 2043 he needs 8 crores. So far in mutual funds, he's accumulated 7.15 lakh. I want to understand if that is the, okay, that's a total invested amount, it seems. He has Canara Robeco Emerging Equity, Parag Parikh Flexicap. He also has Kotak Emerging Equities, SBI Small Cap and Nippon India Small Cap. He's invested directly into shares as well. And PPF he has for himself and his wife, 7 lakhs each, NPS 5 lakh approximately, and sovereign gold bond 1 lakh. Current SIPs are also going on. The above mentioned funds were lump sum investment. He's got SIPs in Kotak Flexicap, SBI Small Cap, Kotak Emerging Equity, and he's investing in NPS also. So that's a portfolio. I think now if we get Ankur online, maybe he can just hear about the portfolio checking that's Hemant about to do. Hemant, over to you.
Yes, Kavita. I think important thing, like you rightly mentioned, I think he's defined his goal very well, defined his time horizon very well, which is, I think, absolutely important for anyone who wants to plan for these important goals, because all these 3 goals are very important: child education, marriage, and retirement. And he is very clear in terms of how much time he has, and he has actually assigned also a target for each one. And good thing is that he started building his portfolio. He's investing in, like you mentioned, in mutual fund, in stocks, PPF, NPS. Now what he needs to do is, since he has begun his investment process already, he needs to align these investment to individual goals, because this is very important. If you don't do that, it becomes very difficult for you to track how you are going ahead with each of the goals. So in this case, let me begin with child education. The money is required in 2030, around 7 years time. Target is 50 lakh. I would say that whatever he has accumulated in the mutual fund, which is 7.15, plus his stock portfolio of 4 lakhs, and current his SIP investment is around 21,000. So I would say maybe align 18,000 to that goal. So if he continues this SIP for the next 7 years and allow this part of the portfolio of mutual fund and stocks to accumulate over the next 7 years, he should be able to achieve that target. So the first target, I don't see any problem. Second, for the marriage, he requires around 75 lakh. So he has another 7 years for that. So in all, 14 years. Like I mentioned, he has a SIP of 21,000. We have aligned already 18,000. So the remaining 3,000 for the next 7 years and 21,000 for the next 7 years. Okay, we'll get him something around 40 lakh. He will have a shortfall of around 35 lakhs. He needs to add his SIP by 8,000. So his SIP should go from 21 to 29 to achieve the second goal. For the third goal, which is almost 20 years away, and the target is around 8 crore, that's a huge target. What are we left with? We are left with basically the money that he has invested in PPF in his name and I think in his wife's name. He is also investing on a monthly basis in NPS and also investing 50,000 lump sum. So these two have to be aligned to this goal. And we talked about the 21,000 SIP. After 14 years, he'll have another 6 years till his retirement. He can continue with that. So with all this investment, he should be able to accumulate something around 2.25 crore. So there is going to be a shortfall of almost like 5.75 crore, for which if he wants to plan from now, he will have to increase his SIP by 30,000. And in addition to that, step up SIP by 10% over the next 20 years. So clearly we can see there is a slight mismatch. In fact, in his retirement goal, he needs to either relook at his goal or maybe make an effort to increase the SIP the way I just mentioned. In 3 funds that he is investing through SIP, I think they're all good funds. He can continue with that. But I would, urge him to keep one thing in mind, that if he's increasing his SIP in future, he need to bring down his allocation to mid and small, because right now it's almost 67%, which is being invested there. He has 2 small cap funds there, SBI and Nippon. He should keep only one. There's no need for him to keep 2 SIP. So two small cap funds. So some changes, like I mentioned, rework on the target. And if he does that, he should be able to achieve his targets.
All right, so that was the solution for Ankur. But then we move on. We have Prabhakar from Gurgaon on the phone line. Prabhakar, hi, good evening.
Hi, good evening.
Thank you so much for sending us your query. And I believe you are investing in index funds.
Correct.
Okay. And you want an inflation-beating return, and you want to know what will be the scenario post-taxation, and you want to know downsides of these index funds. Any specific reason why you want to invest only through index funds?
Because it's minimal headache. Monitoring is one thing which I don't want to do. And if it's index funds, right? So it's the market which is deciding the constituents rather than a fund manager. So if I choose an active fund. So the constituents I need to keep an eye on, the returns I need to keep an eye on. Rather than that, I want minimal headache, minimal worry. So it's index
And
funds.
what about
I
the fund
treat them
manager's
like fixed deposits.
expertise? What about the fund manager expertise? You don't want to take that risk?
No, I don't.
All right.
Because market is better. The overall market is better than an individual, is my perception, for an average return.
Not even a balance of passive and an active strategy in your portfolio. You don't even want that.
No.
Maybe because for few market cap categories, you might just want to, just follow a nice and big fund manager who's proved, to been there in the market around and given returns to their funds. For a large cap, maybe you can have an index fund strategy, but for a mid cap, small cap, not open for a fund manager strategy as well?
So similar thing, I would rather have an index fund for the small cap and mid cap as well, because let the market determine the constituents than a fund manager.
All right. So we got the sense of it now. Hemant, what will be your suggestion or recommendation?
Well, Kavita, I think Prabhakar has made it very clear that he actually wants to kind of remain invested in index fund. He likes index fund better than active fund. But let's touch upon certain important points. There is no doubt about the fact that investing in index fund can be a good idea because one, there is a complete transparency in terms of what kind of stocks which are going to be there. There is well diversified portfolio. There is no human bias. There is a low cost. But at the same time, I think it's important for us to understand when you're investing for the long term, if you rely only on the index fund for your portfolio, you forfeit the chances of earning better than market return. Even though Prabhakar has mentioned very clearly that he doesn't want that. But the fact is, as an equity investor, when you're taking a risk of being in equity, it's important that you make an attempt to get better return. And I think India is a market where we've seen, as you rightly mentioned, Kavita, that the fund managers have been at least in two segments, in mid and small or a different category of fund like large and mid or multi-cap, have been able to deliver alpha. And I think that should continue for the years to come. Now, if I look at his portfolio specifically, there are three funds, because it's very important for us to choose the indices very well. Here, there is Nifty 50, there is Nifty Next 50, and there is Nifty Equal Weight, which means that, Prabhakar, your entire investment is going into the top 100 company only in the large cap. But the fact remains that when you're investing in equity for the long term, there are segments like mid cap and small. If you choose them in the right proportion, they can actually make a significant difference to the portfolio return that you can make over the longer period. So, my advice certainly would be that even if you want to remain only in the index fund, you must include the small cap and the mid cap index fund in your portfolio. Again, like I mentioned earlier, I think there is an opportunity for you to consider a mix of index fund and active fund to ensure that you can get better return. As far as whether you'll be able to beat inflation, look, equity as an asset class has the potential to deliver positive real rate of return. You may not be able to get that alpha, but definitely you'll be able to beat the index over a longer period. There is absolutely no doubt. But I would definitely recommend having a mix of passive fund and active fund to improve your portfolio return considerably.
All right, Prabhakar, is there anything else you want to ask Hemant?
Yes. So the first thing is just regarding the inflation return itself. When you say that an index fund would be able to beat inflation, that is post-taxation, right?
Oh yes, when I'm talking about Prabhakar, real rate of return, basically two important things. We're not looking at only gross return, we're looking at inflation, obviously, and the taxation. Because what happens is there are a number of studies that have been done. So significant part of your return comes from your asset allocation. But like I mentioned, the alpha is created by the fund as an active fund. So you will still be able to get a significant part of what equity market have to offer over the longer period.
Thank you, Prabhakar, for sending us your query. We have Rajbir from Amritsar on phone line. Rajbir, hi, good evening. How are you doing today?
Very well, ma'am. How are you?
I'm doing good, thank you. UTI Flexicap 4,500, Axis Flexicap 2,500. You want to know if you can continue in these funds or you want to switch or you should switch, right?
Yeah.
All right. Hemant?
Well, I think as the name suggests, both these funds are in flexi-cap category. And what has happened, we've seen the last 15, 16 months that the market didn't move much, barring the last maybe few weeks where we've seen some kind of growth happening. We've seen the market moving up. So what has happened is, during this period, we didn't see really good return from the equity fund. Maybe that is what is reflecting in the portfolio. The second important thing is both the fund that he's mentioned follow growth investing, basically. So what has happened is we have been in a scenario where the inflation was very high, still very high, and the interest rates are moving up. So in a scenario like this, the growth stocks do not do well. That's where we saw the difference that during this period of 15, 16 months, the value investing performed better. But I think we are getting to a stage now where we are seeing that maybe interest rates have peaked. We may see interest stabilizing and maybe after a couple of quarters, see globally maybe interest rate coming down. Obviously, some countries will take slightly more time. But the point is that now that we have gone through that period of difficult times of where we didn't get much return, my advice to you would be that both these funds have excellent portfolio. And I think the growth stocks will be back in favor maybe in the next 2 or 3 quarters. So my advice would be that you continue. And don't forget that all that investment that you made in the last 15, 16 months through SIP will definitely help you when there is a turnaround in the fortune of the growth stock. So continue this for some more time. And I think you will see that these funds should be able to make up for the lost time over the next maybe year or so.
Anything else, Rajbir, you want to ask? All right, thank you so much for sending us your query. We move on and we'll take Christopher's question. He's invested 50K in Mirai Focused Fund in April 2022 and he's not seeing profit till date, and he wants to understand if he can just redeem the entire amount and invest it somewhere else for almost 3 years. That's the time frame that he's looking at. He's got Parag Parikh Flexicap on his mind and also Motilal Oswal SNP and DSP Innovation Fund. So, yeah, Hemant.
Well, Kavita, I think again, he invested in April 22. We are talking about the same period where I mentioned the market didn't do much, and especially the growth stocks suffered because of higher inflation and, of course, higher interest rate. Again, this is a focus fund. So obviously, one, the market didn't do much, and the focus fund, because they take concentrated bet, you will see more impact on such fund. But broadly, I would say this fund has a good portfolio. You can give it some more time, but there are 2 important factors to be considered. One, whether this is the only fund in the portfolio. Second, whether significant part of the portfolio has been invested in this. If that is the case, definitely there is a case to maybe take out some money and look at, like you mentioned, Parag Parikh Flexicap Fund. But if this is a small part of your portfolio, if you can give it some more time, like I said, growth stock should be back on track, and this fund should make up for for the last whatever lower return that fund has given in the last 1 year or so. But like I said, the final decision will depend on the composition of your portfolio and the size of it.
All right. On that note, time to wrap up. Thank you so much, Hemant, for being on the show and helping our viewers with their financial portfolio queries. And before I sign off, I'm going to leave our viewers with our WhatsApp number and email ID where we keep waiting for your mutual fund or financial portfolio related queries. Thank you so much for watching. Goodbye.